Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Asian markets as of now have opened up a bit mixed. Look at the Taiwan index, that's down almost 1%.
The next resistance comes in at 23,960 and then 24,551.
This is also coming at a time when Gensol has leased around 5,000 cars to Blue Smart Electric Mobility.
Decent start, about 1/3% higher on the Nifty. The Nifty Bank, I think, is at a record high.
Yes.
Valuations have corrected and are pretty much, at least in the large cap companies, are closer to the levels where one would ideally want to invest into these companies.
A number of almost maybe 125 to 130 billion units incremental will be required, which when converted into capacities will be about 25 to 30 gigawatt of fresh capacity.
Both banks and IT are on the way up. Banks, because the numbers from HDFC Bank, ICICI Bank have been fairly robust.
These uncertainties clearly are adding premium, and a safe haven buying is happening only in gold.
Completely green, as you can see. The mid-cap index is up over 2.2%.
Well, it's an absolutely stunning day once again, starting the week in style, and the market is breaking records. At least the Nifty Bank has, and the Nifty, in a way, sort of also has. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, and it's all green. Rima, hi.
Hi, we've just taken off from where we left off, right, on Thursday. Yeah. Last week we rallied, 4.5%, 6.5% on mid-caps. And markets like a rocket last 4 days.
Like a rocket, and it's continuing.
It's continuing.
And, I think the flows are going to be strong once again. It looks like it because the momentum suggests that. It's not, the covering bit, etc., got over the week before last, towards the end of the week before last. Last week, of course, there was massive FII buying which happened. And I think today's number should also be pretty solid, all told. So, this is looking good. We were talking about in the morning that it looks like the breakout from the 23,800 levels, which failed last time, will sustain. Well, it's sustaining, and how? We are past 24,100 now, and the level to target from here is 24,551. That's essentially extension targets based off what we've seen. And for the Nifty Bank, the next level is about 56,000. I think 500 or so, 400 something. With the levels we put out in the morning, it's just that it's all sort of happening so fast now. And the banks, the first big index to come back to new highs. And, the mid and small caps are also participating equally. So last week, they kind of lagged the large caps a little bit. But today, they're kind of making up 2.5 on the mid cap index. And I think they've got the small cap index, which is also up, strong fashion. It's about 1.95 odd percent. Rima.
Yeah, it's a very powerful start to the week. Look at the advanced decline ratio. 4 stocks gaining for 1 stock declining. And both banks and IT are outperforming today. The Nifty banking index up nearly 2%, while the IT index has a gain of about 2.5%. And this is despite disappointing numbers coming in from many of the IT majors. Markets in Europe today are shut on account of Easter Monday. The global markets, the ones which are trading, even in Asia, a bit subdued. So the Taiwanese market and the Japanese markets closed with a cut of more than 1%. And right now, the Dow futures is down close to about 1%. Running you through some of the big large cap gainers on the way up. Peppered with IT and financial. So Tech Mahindra is the top gainer, 5% up. Trent is giving it company a good 4.5% up move. Innocent Bank, a stock which gained 15% last week, has added on another 4%. And then you've got strength in Power Grid, HCL Tech, Bajaj Finserv. On the way down, Adani Ports is struggling, HDFC Life. These are the only 2 Nifty companies with a cut of more than 1%. And then some FMCG staples under pressure or not participating in the up move. ITC, HUL, Britannia, Asian Paints. These are stocks with cuts anywhere between 0.5% to 1%. So how should you position yourself in the last hour of trade? Mitesh is now with us with a few closing strategies. Mitesh, a long call would have worked beautifully. The Nifty is now well above that 200-day moving average of 24,050. 24,150 now, 300 points up. What should one do? Is there opportunity to add to fresh long positions now, or just close and wait it out?
See, good afternoon. I'm not really keen to add on to long positions for two reasons. While I believe that there's still more upside left, the entry point doesn't offer you a very good risk-reward equation. You run up too far away from the 10-day, 20-day averages. There could be a pullback any point in time. We are slightly getting close to overbought levels as well. So what take fresh longs on the index? A good way would be to look at stocks which have been sideways in the last 1-2 days, are trying to give some kind of a reversal today and trying to move up. So that could be a good way. But the bias and the directional view preference is on the upside. So I have a buy on Bosch Limited with a stop at 27,500 for targets of 28,500. And also a buy on Birla Soft. Keep a stop at about levels of 380, just below 380 here, and look for a target of 402 to about 405.
Okay, lots of IT stocks are higher, even in the mid-cap IT space. So Birla Soft is one of them, but Emphasis 5% up. You've got a Tata Tech, Cyan, Coforge, Emphasis, all up between 4.5% to 5%. In fact, the up move in IT would have surprised many because the news was negative. So Infosys, for instance, disappointed the street with the Q4 print. The guidance for 0 to 3% was also lower than street expectations. But the street is happy that at least one, they've given a guidance, and two, it seems to be slightly better than the worst case scenario, what was feared in the market. So that's what JP Morgan says. The guidance is below the guidance set, the prior expectations 3 weeks ago, but it's better than the recently feared one after Wipro's print. Citi says that the guidance is decent in the current backdrop, though the higher end appears to be a little aggressive. Brokerages are fairly bullish on IT. So Kotak, for instance, says that Infi will have a muted FY26. Infi in particular is more vulnerable compared to others on account of its discretionary exposure. But its strong positioning in vendor consolidation, cost optimization deals will help company weather the storm. So they have a buy rating, target price 1,700. In fact, I think about 70 to 75% of the IT analysts who track Infosys have a bullish call on them, on it. And these are some of the ratings. The other one which catches your attention is Just Dial. A powerful move on that. 3 quick reasons why the stock is doing well. 1, improvement in the collections now in double digits for Q4. 2, cash in the books above 5,000 crore rupees is 60% of its market capitalization. And 3, the company, despite slow revenue growth, is improving its margins. So in FY25, margins improved by 8.6%, 860 basis points, and now at 30%. Conference call today is at 6 p.m. And Tata Elxsi has been the big mover. Again, this is one that's taken everyone by surprise because numbers were very disappointing. Top line degrew by close to about 5%. Maybe the company's guidance, what they spoke in the conference call has infused some support because they spoke about stability in Q1, FY26 being better than FY25, and then the strong deal wins that they've announced in Q4. All that will aid. And plus, the stock has been an underperformer. In the last 3 years, the stock has lost close to about 35%. Dipan Mehta is now joining in. Dipan, first come in on all these 3 IT names. The question is it just like a dead cat bounce from oversold regions levels because the Nifty IT index was down 25% from the start of the year? Is this just a tactical or a dead cat bounce, or do you think all the bad news, at least for FY26 or the first half, appears to be in the price?
Yeah, good afternoon, Rima, and thank you for having me on your show. I think it's more of short covering taking place over there, and maybe investors are taking a longer term view that beyond the slowdown which may come or the uncertainty post Trump tariffs, once it's over and done with, maybe you could see a slight revival in the earnings. But I'm not convinced, and I think investors need to be extremely selective in IT shares, and there'll be only a very, very few winners in the entire space, according to me. Coming specifically to Tata Elxsi, you're right. I think the numbers are disappointing, but the deal wins have been exceptional, that too across all the 3 verticals of Tata Elxsi. And I think that maybe a quarter or 2 down the line, growth may return to Tata Elxsi in a pretty strong way because base effect also will benefit, and a lot of these deals also will start getting into implementation stage. And of course, the stock has nearly halved. So therefore, from valuation point of view, there is some amount of comfort. But you have to try and be very selective when it comes to IT. That's my summary.
Very selective as far as IT is concerned. Deepan, hi. Good afternoon. You know, the top gaining sector is the capital markets index, flying 4-5%. Just coming off oversold levels. Of course, it's a function of the market getting a little better as well, isn't it?
Yeah, actually, Prashant, good afternoon. The sensex, Nifty, and the capital market stocks are going to move completely in tandem, and they're dependent upon higher volumes and more interest coming in from investors. And so it's natural that these stocks should do well. These companies also have seen a steep correction. Maybe this quarter numbers may not be that impressive, but investors seeing beyond this quarter, maybe in the next quarter, the June quarter, you may have better numbers coming through. If we are convinced that the bottom has been made, and from this point on this foundation, stocks will gain momentum and volumes also will pick up. So yeah, but I think the real story is in banks, and we saw what happened with HDFC, ICICI. I think it's going to make the best alpha is going to come from banks and NBFCs, especially small mid-cap banks and NBFCs.
Okay, you know, in terms of constituents, look at Nippon India. If you can put these stocks up, we showed the index. Nippon is up 6%. This is the capital market constituents. That's Nippon India. The mutual fund BSC will come up next, 6% there. HDFC AMC is up 6%. KFintech, and you, by the way, you will hear from the KFintech management in just a bit from now. That's flying. Angel One is up 4.5%. We spoke with the management this morning. Angel. They're expecting FY26 to be a year of consolidation. And of course, 26 then 26 will be a year of consolidation. 27 will then look better. That's the word coming in from Dinesh Thakkar. Motilal Oswal is up 4.5%. Aditya Birla mutual fund is up, asset management is up 4.5%. MCX is up 4%. UTI AMC is up 4%. So there is a fair bit of activity and action coming through in this particular space. You think action will move to outside of banks as well, Deepan? To what segments? I mean, IT, you said one has to be careful. Banks and financials, I mean, you know, because we're back to highs here in this space. Where else you think? Because FIs are coming back, I mean, stomping back into the market. Looks like it at least. Last week was big, the big numbers, and this is going to continue. Where else you think?
See, Prashant, if we are convinced that the next phase of the bull market, the multi-year bull market, which we've seen for the last several years or so, if that is to continue, and it seems to be so, then the leadership sector has to be the banks and the NBFCs. So from that point of view, very positive over there. Of course, there are other India-centric sectors like engineering, construction, retail as well, even cement, aviation, all of these should do well. But I think the leadership is going to come back into banks. The bank Nifty has underperformed on a 5 out of 10 year basis also. But now I think it's going to come back very strongly with the large companies, ICICI, Axis, SBI, all of them reporting good numbers according to me. And with interest rates coming down, it's going to be beneficial for the entire sector. So investors need to have a very close look at what their exposure to banks and BFCs are and be adequate or maybe overweight in that segment.
In the past, you've said you like Bajaj Finance. At these levels, which bank or NBFC would you like to add?
See, I think that within the banks, also these smaller banks, like first the disclosure we and our clients are invested. I thought IDFC First Bank is at an interesting level. It has also underperformed big time. But now with the deal which has taken place and the overall improvement in the environment, I think that company can do exceptionally well going forward. Within the NBFC space, we still remain very, very positive on Bajaj Finance. And this is one company which will show, I would say, very good outperformance compared to its peer group also. Within the NBFC space, against Chola Investment also looking very interesting to us. And then there's, of course, L&T Finance. So what we're trying to do here is go for multi-product NBFCs rather than focused on one particular segment, be it gold or microfinance or vehicle finance. So that's our strategy as far as NBFCs are concerned. And within the banks, as I said, I think one is, of course, IDFC First. I thought even AU Small Finance Bank may do exceptionally well. It's on the expensive side, but its performance has been quite decent. So, and of course, there are the PSU banks as well. I think across the board, a lot of choices, but this is one segment investors should be overweight in.
And these are all stocks that you own: IDFC First, AU, Chola Investment, L&T Finance.
Yes, as I said, we are following what we say, and we are getting overweight on the banks and BFCs.
Okay.
All right.
Yeah. Go ahead.
All right, Deepan, thank you very much for joining us. Maybe actually, if you want to listen in to the next conversation, we were talking about capital marketplace. We have KFintech management now joining us. The company has announced that it will buy a 51% stake in Ascent Fund Services. We have Shrikant Nadella, the MD and CEO of the company, now joining in. Shrikant, thank you very much for your time. Good afternoon, and congratulations on the acquisition. Could you tell us a little bit about the company that you're acquiring this 51% in, and what do you hope to do with it? What are the synergies, and how will this add to the business at KFintech?
Very good afternoon, and happy to be here. KFintech has entered into a definitive agreement to buy Ascent Fund Services. It's a Singapore-based fund administrator. As you could be aware, KFintech is in the capital market infrastructure space. We are the largest registrar and transfer agent. We manage about 60% of the mutual fund houses in India. We're on the share transfer side as well, managing the IPOs in the secondary markets, also managing alternatives. That's broadly the role that KFintech plays in the capital market ecosystem. It had been our stated goal over the last 5 years to create the country's first and largest global fund administrator at scale. Today, if you see the capital markets ecosystem beyond India, you have several large fund administrators. Many of them are bank-based administrators. Some of them are pure play fund administrators. They combined manage close to about $90 trillion worth of wealth globally. And in that context, they offer services such as transfer agency, which is everything to do with investor servicing, and fund accounting, which is basically net asset value computation, so on and so forth. Given our plan to grow globally, over the past 5 years, KFintech had started organically growing itself, right, in Malaysia, Philippines, Hong Kong, Singapore, and Thailand. We have about 80 clientele, but we constantly look at opportunities to expand the international space as frequently as we could. And given it is a highly regulated space, sometimes acquisitions make more sense than organically growing. In that context, we've been evaluating several assets, and one such asset, is Ascent Fund Services. It's based in Singapore. It's a reasonably young organization, started in 2019 by 3 young entrepreneurs who have scaled up the organization quite well. Today, they manage about $24 billion worth of assets under administration. The company has, grown its revenue profile from nil to near about, $15 to $16 million in a very short period of time, and has scaled to be present and manage clients across 18 different countries, regulated by 6 different administrators, whether it is the Singapore administrator, Dubai, Abu Dhabi, Cayman Islands, so on and so forth. So it is a hugely complementary asset acquisition by KFintech. We intend the deal to be closed over the next 5-year period. And as such, it is, first big step for KFintech towards being a global fund administrator.
Shrikant, so the first step, you're acquiring a 51% stake for nearly $35 million. But you will be acquiring the balance 49% in FY 28, 29, 30, based on certain, if you achieve certain EBITDA, certain EBITDA requirements. If those are achieved, what is expected to be the total payout?
So should they be, so we're looking at a range anyway between about 110 to 170 million dollars with the total payout, entirely dependent on the margins that the organization will deliver in those 3 years.
And the current revenues of the acquired company, you said, I think is 50-60 million, right?
That's right.
Okay.
So for the period ending, Ascent, year is between July and June, and for the first half year ending January, they ended about $13.5 million. The current run rate is about $1.5 million a month.
And by say 2030, if they are to achieve the EBITDA targets that you've set out and will entail a maximum payout of 170, what is the expected revenue and EBITDA that you're looking at?
The base case submitted was close to about $85 million.
So, sorry, what's the business growing at, Shrikant? The Ascent?
Prashant, so we're looking at the metrics in terms of 3 broad metrics. One is the number of fund houses and fund managers itself. That growth had been close to about 57% over the past 4 years. Assets under administration has been growing up north of 45-46%. Revenue profile itself has been growing at about 36% over the past 3 years.
So they essentially cater to all global funds, essentially, right?
Correct. So these are the funds that have been structured in Singapore or Dubai or Abu Dhabi, any of these offshore locations, or direct in-house, geographies such as Hong Kong. Yeah.
Okay, because I mean, I'm assuming it's a big financial center, but it's used as a base to invest around the world, not so much in Singapore, but around the world in that sense, right? So this is, and you said 47% is 57% is the growth over the last 4 years.
Fund managers, yes.
And 40 something in terms of AUM. That's the CAGR.
That's the CAGR, correct.
Okay, and what are margins here, Srikanth?
So it's a relatively young organization, as I said. They just turned the corner for the previous quarter. They turned EBITDA positive. I guess depending as the scale increases, the margin profile will. Our plan is for it to tend to track towards that of KFintech's margins over the next 3 to 5 years.
Just in the immediate term, will there be any earnings cut on account of lower other income and higher non-mutual fund revenues? Some of the analysts we spoke to seem to indicate that at least upfront in the first year, there would be an earnings cut of 2 to 4%.
I do not anticipate that. We are, funding this entire acquisition entirely through internal accruals, right? That's about roughly 300 crores of cash. We believe it will be EPS accretive even in this year, albeit marginally so, given it's already EBITDA positive. I guess so long as our treasury income, we get about 4 to 5% return beyond the treasury income, we should be, EPS accretive this year too.
And what will be the contribution of your international revenues that you anticipate, say, 5 years down the line, given the inorganic aspirations and the organic growth?
So we started the international journey for 2 broad reasons. One, over-dependency on one country and on one asset class, which is mutual funds. And we believe it just makes prudent financial decision to diversify your risks. And the diversification was one across business processes instead of just doing RTA, do also fund accounting, digital technology, data. Instead of just one country, India, be across multiple geographies. Instead of just mutual funds, be across multiple asset classes. So from that context, we believe that, we wanted to get to close to 50% of the total revenue book to come from international in the near term or medium term, if I may, right? That's anywhere between 5 to 7 years. With this acquisition, once the acquisition is completed over the next 3 to 4 month period, the total share of international revenue to overall KFintech's revenue would be up north of 25% already. Over the next 5 years, should we execute to our plans well, we should get anywhere between 40 to 50% of the total book to come from international.
More acquisitions in the pipeline, Srikanth? Or you think this one, at least till you get this done?
No, we continually, evaluate potential targets, Prashant. I know, and we look at acquisitions, from the lens of 3 different angles. One is, to drive certain amount of consolidation, which is basically in the same business, buy out smaller entities, which can help us drive both the, top line and bottom line. Second, new geography expansion, which is where I suppose Ascent acquisition will come into picture. The third one would be a completely new product line or a business line, where we haven't been. For example, our past acquisition of Hexagram is in that regard. We have a very active M&A, and a board orchestrated committee. So we continually look at it. At any point in time, we have 10 different assets we are looking at, and it could fall into any of those categories. Yes, it is possible that we can have more. But first and foremost, of course, we need to complete this transaction. As you know, it's a highly regulated business. We need a whole lot of regulators to clear this, and about at least a couple of quarters for integration and cultural alignment, so on and so forth. But along the way, we'll continue to evaluate more.
But it should get done, right? You have assurances. I mean, it'll be, the regulatory part of it, because you say, it's a highly, very, very regulated industry and it's a foreign entity, but it'll get done. It's just a matter of time, right?
Yeah, we are very confident. There are no reasons why it should not.
Okay, all right. Srikanth, thank you very much. Good speaking with you. Appreciate you joining us here on CNBC-TV18. Good luck with that business. We'll take a quick commercial break here. Markets, of course, up about 300, 24,150 is where we read. Vikas Khemani with us on the other side. Stay tuned. Welcome back. Markets up 300 and it's good going all across. Banks, of course, leading. Vikas Khemani is with us, founder of Carnelian Asset Management and Advisors. Vikas, good afternoon. Welcome back. It's been a while and good block of time has passed since we chatted and so much has happened. But it's looking good after everything which has happened. Looking very, very constructive out there, at least in terms of price action. What's your view, Vikas? And what have you been doing over the last many months?
Grant, good to always chat with you. So I think, we've been throughout this whole, chaotic period. We have said that continuously to our investors and reiterated again and again that India story is far from over. India is the least country, India is least impacted with what's happening globally. In fact, as the noise settles down, India will be neutral to positive. So net India will be beneficiary of this. The only thing is that when there is a chaotic news flow all around the globe, it's very natural to have that India might also fall. And which we saw, though India relatively fell lesser than most of the world, but it is impossible to not get impacted when there's so much noises around the world. And as I think more and more clarity is coming that India will negotiate out of this in a much better position, and US is also kind of retracting from that situation of making it very aggressive situation, which we've said always that there are rhetorics and there are realities. The reality is that US can't manufacture overnight, US can't stop consuming overnight. So where would they get it from? And if you have 140% tariffs, it's only going to be inflationary for you. So I think it's not sustainable. So if you just take the noise around and just think logically, this is how it had to pan out. But at the time of extreme volatility, obviously everybody gets spooked, and rightfully. I mean, I'm not, it's always kind of unnerving when this kind of environment is there. But investing is all about keeping your nerves and, cutting through the noise and, buying or investing, based on your long-term vision, conviction, and thought process. So we think that, the interest rate cut has just, in fact, much before this 2nd April move, RBI had pivoted towards, very easy monetary policy, growth-oriented policy, which was, a 3.5 lakh crore deficit got converted into 1,40,000 crore surplus. That itself was a very big move. That earlier deficit actually had an impact on the corporate earnings 2 quarters with 2 quarters lag. Obviously going to change the same situation back, with 2 quarters lag in the corporate earnings, and that's what we've been saying. That Indian corporate earnings will do well. I have no doubt in my mind, even in the current financial year. So if that's the case, then obviously you have to navigate. Nothing is going to impact the entire banking sector, whatever is happening in the US or anywhere else, right? So if that's the case, then why should one get worried and stay away? So that's been our thought process for quite some time, and we've remained invested through thick and thin. We have added weights to the sectors where we have kind of more bullish, such as banking and pharma and some manufacturing bit. So wherever you think that there's no long-term damage or long-term potential damage, we don't know. People wrote of IT. We never got worried about IT because it's only potential, worry. We don't know the real situation, what will pan out. So I think all these things have kind of played out well back.
So you're not worried about IT? Because companies are talking about projects which are being put on hold, paused, delayed, which will hurt growth.
I think we've remained, invested into IT. We've been of course, we've not been overweight. We've been kind of slightly underweight, not even majorly underweight. So we've had our names which we bought. And I think in IT last 2-3 years, people have been calling out for slowdown. It's not the recent phenomena. And despite that, most of our IT portfolio companies have done well. So I think, again, and secondly, if you see, if US Fed rate cut starts happening, with whether that will happen 6 months later, 12 months later, I don't know. But that will be again a great thing for IT. But in general, in my opinion, when economies struggle for efficiency, they can't cut down significantly on IT. So IT will grow between 5 to 10% of earning growth, but the valuations are also very attractive. And within that, you can look for companies which will grow faster. So again, it's not about painting the whole sector with the same brush. You've got to identify companies within that sector and which are kind of still growing well.
No, absolutely. Point taken. By the way, you have pretty sort of interesting holdings, right? I was looking at one of the funds, the fact sheet that you've sent across, Vikas. You got an interesting hospital company, but that's not there's Paytm you own. This is publicly sort of available information. You've got Interag Building Products, a pretty diversified, varied kind of list. Anything you bought recently in the fall, or these are all long-term holdings which you've been which you've had for a number of months now?
For now, and I must tell you that we haven't made any, except tweaking one or two changes, we have not made any change in our portfolio through this fall. Of course, when this kind of fall happens, you take a knock along with the market, no doubt about it. But we've also recovered back and much more than markets in the recovery as well. So, but all the names which you mentioned, their business model did not change at all because of the US situation. Their model is not going to change. Whatever is happening globally right now, right? All of them are domestically focused, either on the healthcare cycle of the country or on the capex cycle of the country or on the banking cycle of the country. So they're all India focused stories. Nothing changes around that. And if those companies were available at a better price, it was a great opportunity according to me, which we kept on communicating to our investors through our calls and to media.
After BFSI, the second biggest weight is pharma as a space, pharma, API, etc. So pretty bullish there, Vikas. And this, from what I see, you've got exposure to companies like Loris, Biocon, and a few others as well. Want to run us through the sort of logic, the rationale?
Yeah, we've been very for long. Not now, almost a year and a half. For long, but even more so specifically in the last 1.5 years, since the early part of 2024, we've been very bullish on pharma and CDMO as a space. I remember buying Loris at around 300 rupees when I think most people were writing off that company, and we had conviction in that capability of the company, on the potential of the company, potential of the sector. And today, I think we have seen that stock, has done well and numbers are coming through. So I think, when you understand a company, when you believe in a management, you can take those opportunities as a entering points. And every company go through that up and down. So, and pharma, CDMO is structurally very, very long. We have said multiple times in our interaction as well with you that, it's 5-10 year opportunity. And, it's like where in some sense IT was in, mid 90s. I won't be surprised if many of these companies will be 5x, 10x from in fullness of time, because that's the kind of, tailwind you have in the sector. And so we've always positioned ourselves in that space very well. And so far we've done well on that. And we think that it's here to stay. And then, of course, like with everything else, it boils down to the company specific and specific management. It's not that every company and everything will do well in the sector as well.
The other domestic theme is consumption. So far, it's the premium luxury consumption which has done well. But now increasingly, there is a view that given the normal monsoon, this K-shaped recovery will broaden out. And some of the low-value consumption, whether it's in footwear, apparel, maybe two-wheelers, will also start seeing a recovery as the year progresses. Not just staples, but even some of the other low-value consumption stocks in areas. Would you concur with that view? And where do you stand on the consumption at the lower end?
Always believe that, see, we've never bought consumption much in last 5-7 years, except last 6-8 months, we bought some companies, but, again, there we don't have a lot of weight. We think that there's a lot of, overvaluation in the sector, given the kind of growth it offers. Of course, it boils down to the companies which are interesting, which can essentially, sort of capturing the premiumization space and, can grow 15-20%. But most companies are growing single digit and commanding at 50, 60, 10 price to earning multiple, which in my opinion doesn't make sense. Unless you get a feeling of or sense of accelerated growth in a particular company or sector, then you kind of play. So we have had some small companies playing out, but in that. But there are also interesting companies we are monitoring. If we find risk reward is there, we'll buy that. But generally speaking, consumer discretionary still looks better than consumer staples. Given the fact that most staples are, not growing, and more importantly, we have said, Ima, that companies, it's not the consumption which has been slowing down. It is more, I think, that consumption patterns are changing. It's more that, newer incumbent players are getting challenged by the smaller, nimble, agile, innovative players sitting in different parts of the country in small towns are giving challenge to the larger incumbents. So it's not only demand in slowing down, it's probably democratization of the market or large to small shift is happening in the space. And that I think is, in my opinion, market is ignoring and it is assigning to the slowdown in the consumption. I don't think it's as much a slowdown in the consumption story. It is the changing industry pattern, changing consumer, consumption pattern. That is a lot more relevant, and hence one has to be very mindful of this fact while investing into the consumer stories.
Absolutely, and point taken, Vikas. Good conversation, good chat, and continue with the performance there. Thank you very much for joining us. It's a pleasure here on CNBC TV18. Well, I think we're going to take a quick commercial break here. We'll come back, a quick check with Dealing Room. Nimesh joins us for that, and we'll get you some short-term ideas as well on the other side.
Welcome back. Holding on to pretty much all its gains. It's up more than 1% as we count down to the last 30 minutes of today's trading session. It's been a strong Monday. Nimesh is now joining in to get us all the D Street chatter. Nimesh, should we expect another strong FI buy figure?
Well, looks like, Rima, that's the overall feedback, that there is buying, and there is buying in banks, OMCs, as well as the MFI space as well. So that's from a flow perspective. But it's clearly the momentum from last week, which continues in today's market as well. The Nifty is about 24,000. The bank Nifty is at record high, up to 2%, another 2% gain. And now it is spreading into the broader market stocks as well. The broader market, the mid-cap index is up 2.5%, but a lot of individual names have started reacting and buzzing in the last couple of days. And today is clearly a day for the broader markets to outperform. So a lot of MFI stocks are doing good today. The small private banks are buzzing in trade, and a lot of buying as well from larger institutions. The three space, as I spoke about, private banks, especially the smaller private bank stocks now, MFIs and OMCs. These are the three pockets where there is buying from larger institutions. We've been talking about 23,800 as a big resistance. Now that will turn out to be a big support on the downside. So watch out for that levels on the downside. But looks like, given that about 24,000, 24,100, you could see a further short squeeze and a rally in the Nifty. So that's overall feedback. But clearly, flow seems to be positive again in private bank stocks.
Okay, all right. Flow seems to be positive in private bank stocks. Nimesh, what are you picking up in terms of specific stocks?
Well, so in terms of individual names, the first stock on my list is Shami Hotels. That's been buzzing in the last couple of days. In the last 1 month itself, I guess the stock has rallied all the way from low of 140, 150 to 180 now, and the volumes have also picked up. In Shami, the buzz is that maybe you'll hear a corporate development very soon. A potential fundraising at an SPV level from a global sovereign funds. That's the buzz as far as Shami Hotel is concerned. So that's the first stock to watch out for. The second stock is IDFC First Bank. I've been covering for the last few weeks. It's come into my charter list few times. And even after the fundraise, the stock has been outperforming, largely on back of aggressive HNI buying. I understand one large HNI investor has been aggressively buying in the last couple of days, and hence a big up move with that name. So that's the second stock. A third couple of stocks where there is the delivery-based buying today, Aditya Birla Capital and as well as ABB India. Both are unusual names to figure out in the list of large FI buying in today's markets. Expect high delivery volumes on both the stocks today. And on the flip side, while Bandhan Bank is up today 5%, there is selling is what I understand. So delivery-based selling in Bandhan Bank, and also there is delivery-based selling happening in Max Health for the last few days. So especially in Max Health, the feedback is one large FI long-only fund is an aggressive seller, hence you'll see delivery-based selling in those two names today.
Well, interesting list of names as always, and Sami, we'll keep an eye out, Nimish, as you pointed out. Stocks up about 25% over the last 1 month or so. And actually, it's come up very, very quickly. And as Nimish points out, maybe a corporate development soon here. Mitesh is now joining in with what to buy or sell today for a reverse trade tomorrow. Mitesh, what do you have?
Yeah. Prashant, the BTST on its side with a stop at 380 for targets of 388 and Federal Bank. That's the BTST with a stop at 200.5 and a target of 205.
Thank you. So let's now go across to Abhishek, and he's here with a snapshot of how the large banks so far have performed in Q4. Abhishek.
Well, the banking sector, which saw some numbers coming in for Q4 FY25 over the weekend, actually surprised positively given the fact that deposit growth was seen over there. And despite that, you saw net interest margin improve. The interest rate have started to decline from Feb of 25 onwards, wherein we saw RBI cut rates, and hence the interest rates started coming down a bit. However, the surprise has come in from growth in deposits, which has come in at a lower cost in Q4 FY25. So all lenders who reported numbers over the weekend have seen interest expenses growth on a sequential basis being lower than that of the deposit growth. Take a look at SDFC Bank, 5.9%, ICICI Bank, 5.9% growth, Yes Bank, 2.6% deposit growth, but their interest expense growth is very low, which is a heartening factor to see. In fact, Yes Bank saw interest expense decline by 4.7% on a sequential basis. Now, some part of it has to do with low-cost deposit accretion. Over the last few years, what we have been seeing is that the banks have actually lost out on CASA ratio, and this is perhaps the first time that we are seeing momentum coming back in the CASA ratio for the banking sector. So sequentially, you saw improvement in CASA ratio of all these banks despite strong deposit growth. So this has actually helped the NIM of the lenders to improve on a sequential basis, while expectations were there that, high cost of funds will actually result in NIM decline on a sequential basis. Even if you remove one-offs in SDFC Bank or ICICI Bank, the net interest margin has actually remained healthy or improved on a sequential basis. Now, NIM were also led by the fact that quarterly annualized slippage ratio declined for most of the lenders on a sequential basis. Hence, their asset quality saw massive improvement on a sequential basis, with the likes of, best in 10 years or even more reported by ICICI Bank on their asset quality front. As a result of improvement in NIM as well as lower credit costs, the return ratios of the lenders saw improvement. ICICI Bank, for example, a 2.5% plus quarterly annualized, ROA is one of the highest that they have ever reported. Take a look at the valuation picture. Valuation is always driven by return ratios improvement, and we are seeing that large private banks like SDFC Bank, ICICI Bank and Axis Bank are trading at a price to book value anywhere between 2.6 to 2.8 times. SBI is trading at a price to book value of 1.5 times. X of SBI, PSU banks are largely trading in the price to book value range of 0.8 to 0.9 times. IndusInd Bank, amongst the private counterparts, is the cheapest bank trading on bourses today. Back to you.
Thank you very much for that. So far, the picture is pretty. NIM's improvement, asset quality looking better. By the way, the street seems to have liked the KFintech management speak. The stock has moved up close to about 8.5%. It was higher since morning, but it's seen a spike after the management said that the total payout would be at max $170 million. It will be EPS accretive from year one. And with this acquisition, the contribution of overseas revenues will rise to 25%, but they want to further increase it to 50% in the next 5 to 7 years. KFintech up 8%, 9% now. Let's focus on the City Gas Distribution Company. The government is taking measures for sustained allocation of affordable gas. Sudarshan is here with the details.
So government over the weekend has made some changes to domestic gas allocation for city gas companies, and it includes both APM, that is administrative price mechanism gas, as well as new well gas. So in the first, it says that now the allocation would be done in advance, basically in 2 quarter advance. These city gas companies would know exactly how much gas, both APM as well as new well gas, they will be getting. And second, this domestic gas would include both APM and new NWG, and new well gas now would be done or allocated on pro rata basis. So as of now, it used to be allocated as per auction. Now it would be allocated as per pro rata. Pro rata means it would be allocated as per the demand. If IGL has more demand than MGL, then IGL would be getting more gas than MGL. And in third, it has given the allocation ratios of the last few quarters. Government says in Q3 FY25, the allocation ratio was 54.7%. In Q1 FY26, also it says it's 55.7%. And Q2 FY26, it projects that ratio would be around 54.74%. So basically, giving the allocation ratio, government is saying that there has not been much change in the allocation in the last few quarters. But mind it, this includes both APM as well as new well gas, and that's the reason you're not seeing major changes in the allocation ratio. As per the communication that we have received from major city gas companies like IGL and MGL, APM gas allocation has reduced, and now currently it's in the range of 37 to 38%. And as far as new well gas is concerned, its allocation is in the range of 17 to 18%. And the price of new well gas is at least 20% higher than APM. That was the reason when government had decided to reduce the allocation of APM gas to city gas companies. It had raised certain concerns among city gas companies, and also even all these brokerages had raised concerns. Now, this what exactly analysts believe? They believe that apart from this detail that government has given about the allocation, this softer crude and LNG prices that they are going to, they expect that it will remain soft, not only in the near term, but even in the medium term, say over 12 to 18 months. And this is going to aid the margin of all the city gas companies. And as far as the government action is done, now the announcement of like in 2 quarter advance, all these city gas companies would know exactly how much volumes they will get. At least it will help them knowing that, okay, these are the volumes they are going to get for the next 2 quarters, and they can plan the volume accordingly. So overall, it's positive for city gas company, and that's the reason you are seeing big move.
Absolutely. So thank you very much for that. Very, very interesting story there. We're going to welcome in Anand Tandon now, who's... Okay, I think let's just focus on Gail as well, which we're going to sort of talk about. So the natural gas regulator, PNGRB, has floated a consultation paper for review of natural gas pipeline tariffs. Sudarshan is here with details on this one and what the street is making of the development. So back to you.
So over the weekend, this regulatory body, that is PNGRB, has floated draft paper for the review of the tariff, and this would be for the pipelines of Gail. So overall, Gail has 10 pipelines, and on the draft paper, stakeholder has to reply to Gail by 1st of May, and Gail has to reply back to PNGRB by 15th of May, and post that PNGRB will hold open market open house discussion, and after that, in the board meeting, it will decide that if tariff has to be increased. As far as Gail's proposal is concerned, it had proposed an increase up to rupees 78 per MMBTU, and after certain queries from PNGRB, that price was reduced to rupees 77.43. Last month, we had a conversation with Gail in which company had said that, yes, it had proposed for increase up to rupees 78, but even if PNGRB approves hike up to rupees 70 per MMBTU, it should be taken positive by the investor as well as brokerages. And also today, CLSA has come out with a note. It has upgraded Gail to outperform from whole, and target is increased to rupees 210 from rupees 175 per share, because it believes that tariff hike can come in the range of 20 to 25%. Also, it has increased EPS estimates in the range of 9 to 19%, because it believes that it's the start of the review process, which raises the confidence that in the next or upcoming board meeting that PNGRB will have in June, there is a likelihood that the range of 20 to 25% tariff hike can be seen.
All right. So thank you very much for that. Anand Tandon is now with us with what he's making of things. Anand, Good afternoon. Good-looking screen. Can't argue with price action, can we?
No, absolutely. It's been a stellar rally, and the fact that it's gone up beyond where the whole thing started before Mr. Trump announced his tariffs, it just shows that the market is more sanguine than one had expected, actually.
More coming, you think?
Well, right now there is no sign of nervousness here. So obviously, you have to play with the trend. But frankly speaking, you're back to having concerns about valuations, isn't it? Because whatever correction you had seen, which had kind of moderated the valuations a little bit, had also dropped down earnings estimates. And now those earning estimates remain low because if you look at all the numbers that are coming through, and the ones that are likely to come, the advanced tax figures for the last quarter have not been good. The economic cycle is clearly on the way down. You cannot have a situation, even assuming that the tariffs were to be resigned for the most part. It is very unlikely that it will go back to zero on China. And if the two largest economies in the world were to slow down because of mutual tariffs, it cannot but affect the rest of the economies as well. So you are still looking at a market which has again gone back to slightly higher pricing than you would be comfortable with. The only caveat is that maybe the interest rates will come down a little bit more, and therefore, there may be a bit more sustenance in terms of a slightly higher P.
Yeah, absolutely. Let's just listen on to the financial space is doing very, very well. My colleague Lata spoke with veteran banker KV Kamath, listening to a slice of that conversation. We'll take a quick commercial break here. Back with Anand on the other side.
Challenge that banks will face, are facing and will face, is cost to income ratio. So unless you disrupt that cost to income ratio to 1/4 of what it is today, you won't survive. 1/4. I'm saying if you cannot operate, you will have to be well below the 35-40% people are.
No, ICICI and HDFC
And some people are higher than that. Banks, I think, as they evolve, the larger and larger part will be to the retail sector, because they are, as of now, best equipped, unless they're disrupted by a fintech. The corporates, large part of the corporate universe today, are cash positive. The cash flows are positive and can meet most of their growth needs. At the margin, they may have to borrow. Large part of infrastructure funding will come through a market process, which is outside the banking system. It's already happening.
Welcome back. All gains intact as we wind down to today's trading session. Anand Tandon is now with us for the last leg. Anand, thank you for joining in. First, coming on Tata Elxsi, it was a disappointing set of numbers. Stock is up 9-10%. What explains that?
Yes, the management has talked up the stock price by being very bullish. The reality is, of course, that so far the numbers for the last quarter have been a bit of a disappointment. And it is quite likely that given some of the exposure that the company has, the areas it operates in, especially autos and so on, many and media, those are both sectors which are likely to be disturbed quite a bit for a while because of a suspension of discretionary spend in their target markets. So I would be very surprised to see a huge pickup from there. And I think most analysts are not really buying up the whole story. But clearly, at this time, the market is a little more bullish than most analysts are.
You were surprised with the Infi stock reaction today? Or you think, day on day, it's very hard to tell, of course, which way things will go. But the numbers were subpar, right?
Well, see, the industry is growing at 4-5%. It's not likely to do more than that for the next year. The stocks are trading at 20%, 20 times plus. So, if you're willing to buy stocks which grow at 4% at a PEG of 4 times, well, good luck, because, the likelihood that you'll get a positive surprise from here is somewhat remote to my mind, even if you assume a kind of back to normal kind of situation. The reality is that the innovations in the technology sector have been such that services themselves will be under some pressure going forward, especially in terms of the lower-end coding jobs, which many of the companies continue to do.
There's a rub-off impact on many of the banks after what ICICI Bank and HDFC Bank delivered, and it just... the tide seems to be turning now on the regulatory front. There's abundant liquidity, rate cuts are coming. Would you be buying any of the banking names, mid, small caps, microfinance lenders, any NBFCs on your radar to buy at these levels?
So I still think, we've been bullish on banks, especially for a long time now, especially when it was not so popular in the market. And I think overall one continues to be, though a large part of that action has already happened. There is no doubt that, the companies have, especially HDFC, for example, has now turned the corner and probably from the next year onwards will start to show an increased growth rate on the top line. One of the concerns has been the slow loan growth, largely because of the fact that they are constrained for capital and the deposit. So now their CDR is now less than 100%, and therefore they are in a position to grow. And I would imagine at least a 10% growth for them next year. Many of the stocks have already gone up quite a bit, but even then, on a historic basis, they are still trading at, around between 1.9 to 2.5 times price to book, which for a company which can potentially generate something around 17-18% or maybe even 20% if your fee income is good, kind of figures for ROE is kind of justifiable. So I think there is still some space to go in terms of the frontline banks, especially those where the deposit franchise is strong. And not so much for the NBFCs. I think NBFCs, I think the likelihood of severe interest rate cut is being overplayed again. There are limits to how much we can cut. Liquidity is good only because of the fact that, your demand has come down again. Loan growth has fallen from 16% to 11% now. So you're again back to having a slower loan growth. And I don't see any reason why you should expect to see a sharp increase in the consumer side lending. If it will, then it will actually lead to greater NPAs as well. So net, I think a good private sector bank in the front line or an SBI kind of large public sector bank is still the best way to play the sector.
Stay with us, Anand. Just wrapping up things and we'll come back to you. So, of course, a good day. A Nifty bank making a new all-time high. And the Nifty, of course, past 24,100. Mid-caps and small caps starting the week with a bang, 2.5% each. And IT was, of course, in a way, one of the sectors of the day. And the other one was capital markets, but much smaller space, of course, compared to what IT did. Tech Mahindra, HCL Tech were the two large IT names in the Nifty which stood out. Trent did well. IndusInd Bank, another 4% after last 3 days, 15%. But there were a few others as well. Nothing very much. Adani Ports was down a little bit. HDFC Life and Lever maybe. That's it. These three stocks which were down.